Well, as an ethical investor, there's certain sectors that are very important to us because they align with our charter, and healthcare is one of those sectors. Renewables is another one. Information technology is another one. But there are also very good fundamental reasons to look at these sectors. In the case of healthcare, there's certain macro tailwinds that I think really allow that sector to grow above the general rate of growth in the overall economy. We've all heard of the ageing population, that's one of them. Another one is as people get wealthier through time, they tend to prioritise spending on health outcomes. And another interesting one is just the pace of technological development in that sector at the moment. And an example of that is the transformation that's happening in cancer care, with the change in focus from fighting cancer through chemotherapeutic drugs to actually finding drugs that stimulate the body's own immune system to fight cancer. And we've been able to find some opportunities at the very smaller end in that space as well. And when we break down the overall market return in the healthcare sector, it's been astonishingly good over the last 10 years in Australia. The ASX 300 healthcare component has given you in total return terms around 20% per annum. And that's not just one stock either. CSL has been a big part of that, but the median return, or the total return for the stocks in that sector, for which we have 10-year data, is 17%. And that compares to the overall index, which has given you about 7% per annum. So it's been a fabulous place to have money invested. Healthcare is a really exciting area as an investor because unlike the banking sector, which is quite homogenous, within healthcare we can find opportunities in anything from pharmaceuticals to medical devices to more service-oriented companies, or even smaller cap biotech in areas where we understand the science and we think the companies meet our risk profile. We're not really an index-aware investor, so just because a company like CSL, which has done extremely well, has 8% of the benchmark, it doesn't mean we have to invest in CSL. We really look right across the benchmark, and we'll particularly spend a lot of time looking at smaller cap companies for the next round of emerging opportunities in areas where we think we can get an edge on the market. Some of the things that we look for in healthcare specifically are companies with that valuable portfolio of intellectual property, and we want that to be durable. We're not looking for things that we think can be competed away in the next 2 or 3 years. Other things that we're interested in are companies that have the ability to access those global markets that are going to give them a very long runway of growth. And finally, we want business models that we understand and business models that we think give companies those recurring revenue streams. So often we're looking for, a hardware device with a consumable revenue stream that comes off the back of that. One of the hard lessons I think that we've learned through time in investing in health is the role that government can play in that sector, either for better or for worse for individual companies. And naturally, government is very interested in the price of healthcare goods and services and plays a role in allocating them. Some of our biggest positions have been topical because of COVID, but in this case, some of our bigger positions have actually benefited from COVID because they've played an active role in combating COVID in different ways, and one of those is Fisher & Paykel Healthcare. It's a company where we have sold some shares recently because it's done extremely well, but we do continue to own a material amount of that stock in our portfolio. And to give you an example of how that's played an active role in treating COVID patients, Fisher & Paykel's core business is supplying equipment into intensive care units, which is essentially humidification equipment that attaches to ventilators that people go onto, and one of the reasons they might go onto that is due to COVID-19. So there's been a big spike in demand for that product. But alongside that, they've actually developed a new product which has much wider application throughout the hospital, and that's called nasal high flow, and it's a form of respiratory support. And as COVID has progressed, that piece of technology has become more and more important into treating people who present with COVID symptoms in the hospital. And it's a business that we think has a lot of longevity beyond COVID-19 and has a high level of recurring consumables, and we think it's really brought forward the demand for that product for Fisher & Paykel Healthcare. Completely different kind of company that we're invested in is Healius, and Healius is the old primary healthcare. And that's a company that has been a laggard if you looked over the long term in the sector, and often I think it's when you kind of really look at the laggards, sometimes you find the best opportunities, and we think it's a bit of a mispriced asset in the market at the moment. It's also a company that did see some earnings declines in some parts of its business during COVID, but fortunately for them, they've played an active role in the front line in testing for COVID because they're a pathology company as well as doing various other things. And so they've played a big role in testing for COVID-19. That's allowed them to get through COVID relatively unscathed from a cash flow point of view. And they've recently sold the more capital intensive part of their business, which is medical centres. So they're going to emerge from this as almost a pure play diagnostic and day hospital company trading at a healthy discount to the nearest competitor, Sonic, in Australia. And it hasn't really surprised us. There's been some corporate interest in Healius more recently. We don't really have a view on how that's going to evolve, but we do think there's a great opportunity to buy a mispriced asset here, and that there's an opportunity for the company to grow its earnings at a healthy clip over the next period.